Using market crash to make money in 2023. Hello everyone, today we're going to be discussing market trends in 2023 and how these trends impact on making money. The retail industry has officially begun to cash in on the dip and prepare for a bull market in 2023. Financial observers like Goldman Sachs have commented that we will continue seeing a market crash. Although stocks are not low by historical standards, still major financial organizations are preparing for another market crisis. In this video, we're going to go over some evidence and determine if there is an accurate method of predicting if and when the market will dwindle. We'll go through some bear and bull cases for 2023, and using this evidence, we'll determine what kind of year 2023 will be. Since last year, the majority of stocks have decreased tremendously, up to a maximum of 80% due to a hike in interest rates. Before the pandemic hit, when any company needed some money, they would have to fall back on institutional investors. These investors had some bidden amounts, which would mean they would only lose money commensurate with risks. But during the pandemic, when the market was hit the hardest, these institutional investors did not cover up for companies looking for money. Instead, they held on to whatever money they had so that they could not lose any more money. This was when the Federal Reserve came to the rescue of these companies and bought whatever assets were being offered so that major stockholders in the stock market knew that everything was okay. For the time being, this strategy worked, but the Federal Reserve is not looking to build a financial portfolio, and it eventually had to sell off its acquired assets. This leaves the pricing of these assets to investors. With very low risk-free interest rates at about 4.5%, the investors are now demanding a premium for risky investments. This means that the investors now had a choice of making risk-free investments with increasingly smaller returns on riskier investments. The higher returns on risk-free investments mean that you will have to be promised a significantly higher return on risky investments for enticing you with these options. How does that bode for the economy? So let's take some real-life examples. When interest rates were 0%, the majority of investments went into riskier investments. When interest rates climb up to 5%, the portion of riskier investments is significantly scaled back up to 50% from the earlier 70%. Diminishing returns were also seen in the markets. This means that when interest rates are climbed up, the amount of risk-taking behavior is diminished. We can argue that since interest rates are up to 5%, we have seen the worst of economic crises. Now, the more interesting aspect of today's video is how to beat the market. There are new promising market trends. For example, in this year, 2019, passive index funds for the first time overtook actively managed funds under asset management. Why is active management of funds such a big thing now? The first thing is, since 2009, people have grown skeptical of investors. The second thing has surprisingly indicated how badly managed are actively managed funds. This means that all investors have a chance of making it big either by investing in highly risky funds, or they have a safe guaranteed return for about 94% of the time by investing in index funds. Why do index funds do really well? Well, these funds have accumulated a lot of stock options where these top companies push forward the growth of the market. When a stock is listed under an index like this, it must have three important criteria. First, the company has to be listed in the U.S. and its shares must be highly liquid. Second, the market cap of the company should be about $8.3 billion and must have positive total earnings throughout the last quarter. Third, the performance of each stock is evaluated by an index committee, where if any stock is seen to fall behind the other, it is quickly followed by another. It is also significant to mention that for the top 500 publicly traded companies in the U.S., the top 20% of stocks in the company account for the 100% of growth in the S&P 500 index. Let's take this analysis even further. Which of these companies in the S&P 500 index account for market growth in the past 100 years? The companies which are future market movers are more likely to be in the top 50% of these companies. A company in the top half of this index will have a significantly greater than average market cap share, which means more returns on investments while accruing only a margin of the risk associated. Second, the price of earnings ratio should be closely scrutinized. Stocks with a higher price to earning ratio did significantly worse than companies with smaller PE ratios in the market. So what individual stock should be selected? Research shows that the average stock was traded for about 7 years and lost money even if we include financial rewards. Furthermore, from all the 26,000 that were analyzed in the research, only 1,000 of them led to growth, and about 86 of these 1,000 stocks were responsible for producing more than 50% of the overall market growth. This means that only 4% of actual stocks make more money than keeping pace with inflation. These were the conclusions from the analysis of the past 100 years. This situation is similar to an unwitting customer who wants to win big in a casino. The odds are always against you. This means that we have limited ability to pick the top earning stocks with consistency. But can we do the opposite? Can we consistently pick out stocks which will end up at the bottom of the market? We can do that by looking at the yield curve, which is a graph that outlines investor expectancy of earning from a month to 30-year terms. The yield curve tells us that the longer we have made our investments, the more financial rewards we can expect to get. However, since the past 40 years, the yield curve has been inverted. Some financial analysts have found that the market bottom has not occurred until the yield curve has been non-inverted. Others have argued that this can be a lagging indicator. A more reasonable avenue of research can be combining the yield curve with the VIX reading. Recent evidence indicates that we will see market collapse or bear market only with panic selling. When combined with data, this coincides with a VIX reading of 45 or more in 2008, 2012, and 2020. A contrarian method of finding the market bottom is by looking at the call-put ratio. What is the call-put ratio? A call is a bet that the stock market prices will soar, whereas a put ratio is a bet that stock market prices will decline. When the stock market sees a ratio of 1.8 puts to every call, that means the worst has already happened. A word of advice about using these indicators: always factor all of these indicators in aggregation when determining market bottom, because while one or two of these indicators may be out of whack, in conjunction, these indicators portray a more real picture of market volatility. As far as experts are concerned, it depends on which expert you are asking. For example, JP Morgan believes that the recession has already been priced in, with stocks having already declined by about 20%. Goldman Sachs believes that an interest in peak rates are essential before any stock market recovery can be made, so it depends on who you ask. However, our opinion is that the bottom has already been priced in, and that since the stock market is detached from the economic condition, the market can swing to either direction. I know this was not the most helpful answer, but referring to market metrics daily is probably the wisest thing to do before making future investments. Well, that's it for today. I hope you enjoyed the video. Please do leave a comment on what your reading of the market is. Don't forget to like the video and subscribe to the channel.